gives me immense it gives me immense pleasure to welcome you all to today's knowledge webinar on Decoding Union Budget 2025. We extend a special welcome to Sri Butchibabu Gorantla, partner Gorantla and Associates, as also Sri V.S. Sudhir, partner N A Co LLP. Both are accomplished people in their domain. They are chartered accountants, company secretaries, and highly qualified, highly experienced people. We are very happy to have them address this webinar. Thanks to all our members and guests for joining us today. The objective of this session is to focus on analyzing the impact of various initiatives taken and various announcements made by government during the budget 25-26 on Indian business and overall economy. Now I would like to introduce our speakers. Sri Sudhir VS is BCom LLB FCA. He is a lead partner at N A Co, having their offices at 16 locations. They provide consultancy, audit, and litigation services in indirect taxes. He completed his schooling and graduation in Bangalore, qualified as a chartered accountant in the year 2006. He did his entrepreneurship development program at the Indian Institute of Management, Ahmedabad. And LLB, he did at Osmania University. He is an associate member of CPA Australia. He has contributed various articles in the press and in professional institutes and Institute of Cost Accountants, Trade Journal, etc. He is a master trainer for Indian Institute of Chartered Accountants, India, New Delhi, and a faculty in National Academy of Customs, Excise and Narcotics. He is a visiting faculty of Oxon Business School, BITS Pilani, and a few other institutions. He is a joint author of 3 books on GST, which are Practical Guide to GST on Real Estate, GST Tariff, and GST Judicial Proceedings. And he is also contributing to Manupatra, the legal website. So coming to Sri Butchibabu, Sri Gorantla Butchibabu is a graduate in BCom and fellow member of the Institute of Chartered Accountants of India and also a fellow member of the Institute of Company Secretaries of India. So he is a CA and ACS also. He is a partner at Gorantla and Associates. He has a vast experience of 22 years in the field of finance, assurance, taxation, accounting, corporate law, FEMA, legal and regulatory matters. He has expertise in dealing with taxation advisory, project financing, structuring of the business, FDI advisory, ECB, income tax, and GST planning. Acting as a virtual CFO for SME segment and effectively serving to clients in real estate, construction, banking, information technology, pharma, manufacturing, SEZ, 100% EOU, etc. So I also want to mention that even my Hyderabad, my Telangana incorporated company, he only incorporated for me and he is helping me with it. Okay. And now coming to IACC, I would like to say a few words about IACC. The Indo-American Chamber of Commerce is an apex bilateral chamber synergizing India-US economic engagement. IACC AP&TS branch serves both of our states, the Telugu states. IACC regularly organizes seminars and webinars and interactive meetings for our members. IACC works closely with the state governments for policy formulation, advocacy, and representing on policy issues on behalf of the Indian and American companies. We also work closely with the US Consulate General in Hyderabad on issues related to visas, trade barriers, trade delegations, and other permanent matters. We facilitate B2B meetings for inbound delegations from USA with industry sectors in India arrange outbound delegations to USA in coordination with our partners in USA. We identify potential partners, buyers, etc. IACC have 12 offices across India. Members in one location enjoy the same rights and privileges in other cities as well. With these words, I wish a very productive and fruitful session. Thank you.
Thank you, sir. Thank you so much for your welcome remarks. Now I request Mr. V.S. Sudhir, sir, partner HNA and Company LLP, to kindly address the members, please. Thank you.
Thank you, Mr. Prabhakar Rao Garu, for your introduction. Shika, I hope my screen is visible.
Yes, sir. It's perfect.
Yeah.
Yes.
So, good morning, all, and welcome to this analysis of the finance bill, whatever the budget proposal has been there. And I would like to congratulate IACC for taking this initiative of doing this webinar in by which we'll all be able to understand what exactly is there in the proposal and how this is going to impact us. So the topic which I will be handling would be the indirect taxes. So the coverage would be is looking at what are the changes in customs. While looking at the changes in customs, I have not taken the changes in various goods rates which has happened, because this is a lengthy list and everybody may not be having a interest to uh, uh, everybody may not be having an interest to look at all the rates. So that is the reason I have not done that. So we'll be broadly looking at what are the custom changes in terms of the provision. The small change in central excise and service tax also will be taking through. Not that it is applicable for everything, but just for an information sake, I'll be taking through. And there are certain changes in GST which I'll be taking you through.
Just
So
1 minute. Sorry to interrupt. Your volume can be increased a little bit.
is it better now?
Yes, sir. Better. Thank you.
Okay. So this is the things which I'll be taking you through. Let me start with customs. In terms of customs, there are certain changes which is they made for the provisional assessment. So the people who are into imports specifically, there could be certain cases where that duty cannot be assessed at the time of import because of want of various information. As most of you would be aware that the valuation under customs can be determined under various method if the transaction value is not accepted. Say, for example, when there is a related party and the goods have been imported, there is a deduction value, that is a sale price minus various deduction, or an addition value in terms of cost plus various additions could be there. So all these things require a lot of information and data for making the assessment. So considering this, in the customs, there is a provision of doing a provisional assessment. That means to say that we are not in a position to recognize what is the actual valuation, pending which we are ad hocly assessing a value and clearing the goods for home consumption. And thereafter, we will come back and produce all the information and the assessment would be done. So this provisional assessment is being used wherever there is a dispute with the department. It is not that the importer goes for a provisional assessment. This is the last thing which he wants to do. He wants to make an assessment based on the transaction value which has happened. But in some cases, the department would object, and thereafter the goods would be removed by doing a provisional assessment. The challenge which was coming is that once the goods have been removed by doing a provisional assessment, many of the cases, the duties were paid more than what actually is required to be paid. That means to say that the money is been there with the government. So considering this challenge, what they have done is that they have given an upper time limit for closing of the provisional assessment. So which says that 2 years from the date of filing the bill of entry, you have to make a provisional assessment. In case there is difficulties, then you could approach the commissioner and commissioner can further extend it for 1 year. So thereby, there is going to be a 2 + 1, 3 years is the maximum period for you to close the provisional assessment. So for all the pending cases, the time limit will apply from the date of getting the precedent assent for the finance bill. For all the new assessment, it will be the date of the bill of entry till the date of the provisional assessment till the actual date of assessment. That is where the date will count. Then there is also a provision where the time limit can be suspended. So this can be suspended by the proper officer in certain cases, like that there are certain information which has been called for from outside India and this information is still pending. Or there is an appeal which is pending with a similar matter with the same person who is importing. That too in tribunal, High Court and Supreme Court, not with the Commissioner Appeals. In such case, the provisional assessment, the time limit can be suspended for doing the provisional assessment because they are not very sure whether this can happen within 3 years or not. It is beyond their control. Thereby, the time limit can be suspended. If there is a stay on this particular assessment by High Court or Supreme Court, then it gets suspended. Then if the board has given an order in a similar matter for the similar goods for keeping this in pending, then it can be suspended. If there is any application pending before the settlement commission on the same goods which has been imported, then it can be, the time limit can be suspended. So except for all these things cases, in normal cases, the provisional assessment should be completed within 2 plus, which can be further extended for 1 year. That is one provision. The second provision is that there is also a provision which has been made for revision of the bill of entry. So earlier the provision for revision of bill of entry was there only before the clearance. Now they are saying post clearance also you can come and do a revision of the bill of entry. But there is a methodology and the time which will be prescribed by the rules, which is not there as on today. That is yet to be coming with that has been awaiting. So that is to be there. And the provision also says that the revision, once you do the revision, you need to make the self-assess the duty which has been paid. And when you are revising, there could be two possibilities. One is that there could be an upward revision, or there could be a upward, means in terms of you end up paying the tax, or you reduce the valuation and you tell that you have ended up paying the excess tax. So the short payment of tax has to be paid along with the interest. And if at all there is an excess payment, the revised bill of entry which has been there, that revised bill of entry is only to be treated as an application for refund, and the customs authority or the proper officer has to pass the refund of the excess duty which has been there. So this revision will have to be made within 1 year from the date of payment. The refund provision will be 1 year from the date of payment only. You can get the refund. Beyond 1 year also, you can revise it, but you will not be eligible for refund. But you will, if there was a short payment, you will end up paying even if it is beyond 1 year. Then the proper officer will accept the revision which has been made. In some cases, based on the risk parameter, he can verify your self-assessment. Please remember, this is not in all cases. Only selected basis based on the risk, the verification of reassessment will be done. Otherwise, it will be accepted. While there is a verification being done, and if that is wrongly being self-assessed by the importer or an exporter, then the proper officer can again do a reassessment of the bill of entry which has been there. That provision has been given. And revision is not permitted. You cannot do a revision when you are being subjected to audit investigation, or a refund is pending, or any other case as may be specified by the board. So thereby the revision should be mostly a voluntarily coming and not because of any intervention by the department. That is the sum and substance of this revision of the bill of entry. Some other changes has been made in the customs. So one of the changes which has been made is that they are replacing this settlement commission both in central excise and service tax with an interim board. Earlier, whatever the powers which was there for a settlement commission, all that power will be given for a interim board. So the settlement commission is a forum where wherever there is an offense which has been created, there is a one-time window which has been available where you go and settle the case by paying the amount as may be prescribed by the settlement commission. It is not that you are going to get a full waiver of interest and penalty, but there could be a reduced interest or penalty as the case may be. The settlement commissioner will, as may be required, would prescribe. You pay that particular amount and get an immunity from the prosecution. Majority of the cases, the settlement commission, they go not for getting a waiver of the interest or penalty, they go for getting the waiver of prosecution provisions, all those smuggled cases and things like that. So now that settlement commission, the entire powers has been given to an interim board. So earlier there was a settlement commissioner which would have been appointed by the board. Instead of that, now what they are saying is the board is going to appoint an interim board. The board will be consisting of 3 people, not below the rank of chief commissioner. And this will be recommended or appointed by the board only. And in case all the three officers are going to hear the matter, in case there is a difference of opinion, they have to go with the majority. So instead of 1 person, they have made it into a board of 3 persons so that there could be more rationally in settling the cases. All the powers which was there for settlement commission will mutatis mutandis, that is as is, would apply for the interim board also. So all the pending cases, that is, which has been accepted, the application which has been accepted, but the settlement award has not been given, those cases also will be heard by the interim board, and all new applications from 1st of April 2025 will be heard by the interim board. So this is the transition provision which has been looked at as far as this customs is concerned. And they have also made, the finance minister was also talking about reduction of number of rates. Earlier, there were many rates. Now, before this budget, there are 15 customs different rates was being there. The 15 custom rates has been brought down to only 8 custom rate, which includes the nil rate. So that is what the finance minister had told. And thereby, there has been a change in the tariff rate for various goods which has been coming in. This, I feel, it's a welcome move, because the lesser the number of rates, the lesser the classification dispute is going to be there. So the larger dispute which comes in the taxation would be the classification, then comes is the input tax credit, and then the valuation. So that is how the chronology of number of cases are there. And if you are making more or less the same rate for a particular product, a thin line of difference also would not make, because the rate of tax would be the same. So this is a welcome move which has been done as far as the customs is concerned. A similar proposal of removing one more rate item under GST is also on cards, which is before the rate fitment committee, and they are yet to clear it. So similar to that is going to happen. So in sum and substance, what has been happened, I am not taking you through the specific product rates, which is again a lengthy list, as I told in the beginning of my deliberation, that I am not going to do. On broadly, what has happened is been summarized here. They have reduced the tariff rate from 25, 30, 35, 40 to 20%. So all these 4 rates, 25, 30, 35, 40, has been removed and merged with 20%. These are the 4 rates which has been gone out of the 7 rates which is there. These are the 4, 25, 30, 35, 40, which were there, now will come to 20. So if you look at, there are a lot of items which is there on 40, 35 and 30 comes to 20, which is a welcome move. Similarly, the few products which were at 150, 125 and 100 has been grouped to 70%. So these are the 7 rates which is going to go away: 25, 30, 35, 40, 150, 125 and 100 is going to go away. And the other rates which is going to be remaining. So reduce the tariff rate on certain items also has been reduced. Then tariffize the effective rate in the schedule has also been done. So they have also created some new tariff item for based on the process, like parboiled rice or rice which is based on the geographical instance. Instead of the output, they have looked at a process, and a new subheading has been given there. to remove all the confusions which has been there. And new item tariff has been given for Makana products also, and suitable renumbering and etc. has been done. So they have also identified the waste oil based on the level of various these sort of a chemicals which has been there, and they have classified the goods. This is also more of ease of classification which they have done. Then wherever there is a dual use of chemicals and which is not for pesticidal use, they have identified, given a new tariff item and removed the confusions which has been there. Similarly has been done for a supplementary note also has been given. And World Customs tariff based HSN has been adopted and some alignment changes has been done. Similarly, some pesticides, there is an international convention and they have aligned the classification based on the international convention. And the new tariff to distinguish the precious metal containing 99.9 or more of gold weight, platinum, a new tariff has been introduced to have clarity on the rates and the classification thereof. All these rates will be effective from 1st of May 2025. These things which I have told about in terms of where there is a change in the tariff classification concern. In addition to that, with effective from 2nd of February, that is yesterday only, there are few items where the tariff have been increased. There are few items where the tariff has been decreased and new agricultural cess has been introduced. All those things will be effective from 2nd of February. I'm not taking you to the those products as such. So that is the changes which is there as far as the customs is concerned. Next changes as central excise is very similar to what I've already explained in central excise, that the settlement commission now will be done by a interim board instead of a settlement commissioner. So this is the change of central excise. Nothing much has been there. And as far as service tax is concerned, they have given a retrospective exemption for a reinsurance service, which has been provided under this weather-based crop insurance scheme, modified agriculture insurance scheme. This is with a retrospective effect from 2011 till the existence of service tax. This exemption has been given. So this is only for those insurance company that would be applicable as far as the service tax is concerned. Now there are certain changes as far as GST is concerned. First is that they have made certain changes to the input service distributor definition and the manner of distribution of the credit. So most of you would be aware now in the last budget, they made input service distributor as a mandatory. This is very important. Even today, there are a lot of corporates which I come across, they have yet to implement input service distributor. So 1st of April 2025 onwards, input service distributor has to be a mandatory and not a recommendatory. So if it is mandatory, what is this input service distributor is all about? First and fundamental, this will apply to only those people who are having multiple registration. If any of you have been logged in and you have a single registration, then this input service distributor subject is not for you. You can relax. But the people who are having multiple registration, invariably you will end up taking input service ISD, input service distributor registration. Why? Because there are a lot of expenses in your company which you will incur, which is for the common benefit of the multiple registrations you may be having. Now you may be having state-wise different registration, or within the state you have taken multiple registration for based on your what you call the geographical location or the business vertical. You have taken a multiple registration. There will be various common services, like maybe a chartered accountant service like me. I do a statutory audit of your entire records. Now, when I do a statutory audit, I have done the audit of all the registration put together, and I'm going to give you a single invoice because I cannot bifurcate among various registration. If you have 1520, I cannot give you a 1520 invoice because mine is as a company as a whole. I have done an audit. It is not possible for me to bifurcate my efforts based on your GST registration because that is not a guiding factor for me at all when I have provided my service. So thereby, this sort of a service, you have to mandatorily take an input service distributor registration in one of the offices which is going to incur all such expenditure, and this input service distributor accumulates the credit by various vendor and distributes this credit to various registration based on the ratio of the turnover or the actual usage as per the rules which has been provided. This was mandatory. As on today, it was recommendatory. This is becoming mandatory from 1st of April 2025. If you are not distributing the credit, then there is going to be a challenge in terms of the ITC eligibility, not following the procedure, etc., etc. So you have to be very clear that the ISD has to be implemented from 1st of April 2025. Now, what has been bought in this budget is nothing to do with what I have told. This was already bought in the previous budget. Now what they have told, that input service distributor can also pay tax under RCM. So now what happens if I was not a chartered accountant, I am an advocate. When I am an advocate and I'll give you an invoice, you are supposed to pay tax under reverse charge mechanism. And because I am fighting a case for you for a company as a whole, maybe it is a company law matter, NCLT matter, and the entire company is what I am fighting a case for you. Then this GST, which you pay under reverse charge, you have to pay in reverse. To enable ISD registration also, you can make the payment of tax. Now the payment of tax under RCM was restricted only to the extent of intrastate supply. That is CGST, SGST only was there. Now this budget is saying that you can also pay the tax under IGST also. That means you are engaging an advocate in Delhi. You are in Telangana. What is the tax you need to pay is IGST. Before this definition, the IGST definition, ISD definition did not enable you to pay IGST under reverse charge. It only enabled you to pay C plus S. Now this amendment enables you to pay IGST under reverse charge and distribute the credit. That is a change which they have brought in. Now they have also done a small amendment to local authority. In local authority, they have defined what is a local authority, and one among the clauses of local authority is authority is those authorities like a Delhi Development Authority or an Airport Authority of India. These are all not a local bodies which has been there, but an authority which has been formed with a specific object with the managed funds of a local funds or a municipal funds which has been there. So there was a confusion whether this comes within the meaning of local authority or not. To remove all those conditions, they have made an amendment and told that whatever the local funds is there, and they have also defined what a local fund and a municipal fund means. So this is more of a clarificatory amendment which has been happened. Then there is a change as far as the vouchers are concerned. So vouchers is also having a small background of it. What is an voucher? Say, for example, you are having a voucher of Amazon. So what happens is that I want to give you a gift. I purchase an Amazon voucher and give you an Amazon voucher as a gift, and based on that, you can redeem this voucher and buy something from Amazon. It could be Amazon, it could be an offline voucher, online voucher, various permutation is there. Under the GST law, what they are told, I will look at voucher as two types of voucher. One is a voucher which which can be redeemed only against a specific product only. And there is a single rate for that particular product. Another is generic, you don't know where you are going to utilize. Say, for example, I have a Starbucks voucher with me, and this can be redeemed against Starbucks restaurant services only. So I know Starbucks is going to charge 5% of the GST. What they told, when the Starbucks issues this particular voucher for 1,000 rupees, they told upfront you have to pay 5% GST the moment you get the money, because you know this is going to be redeemed tomorrow, day after tomorrow, or next month, only for restaurant, and the rate is fixed. Now Amazon issues a voucher. In the Amazon voucher, the person who gets the voucher can buy vegetables or cosmetics or electronics based on whatever you want. The Amazon cannot determine what the voucher redeemer is going to use, what rate of GST is going to pay. There they told You pay the tax only when you are going to redeem. These were the two things which was there under the GST law. Then there was a town's of litigation which happened where the Karnataka High Court told, sir, let us look at what is this voucher. This voucher is nothing but an actionable claim, which is not subjected to GST. Specifically mentioned under Schedule 3 that it is not a item which is subjected to tax. So when a voucher has been given which is not subjected to tax, where is the question of paying upfront? It's not a taxable at all. This was been accepted. There is a circular which has been issued. The circular is now clarifying. Now what they have done is they have removed the time of supply, and they are also giving a clarification saying that any vouchers which has been issued is an auctionable claim. At the time of issue, it is not subjected to GST. Second, the voucher can be traded also. So there will be a person who buys Amazon voucher in bulk, again sells that into retail. The person who is trading in voucher is also trading in actionable claim and which is not subjected to GST. No GST to be paid. Now, the person who is redeeming it at the time of redeeming, whatever the tax is there, the tax has to be paid by the person who is getting the voucher getting redeemed. That is what is there. They also talked about what if this intermediary person is not doing a trading but acting as a commission agent for the original thing and takes a commission. The commission is subjected to tax. All other promotion, branding, all other services will be subjected to tax at the rate of 18%. They also made a clarification saying that I have issued a voucher. The voucher was never redeemed at all. It got missed. Then no tax is to be paid because there is no supply which is going to be given. So this is the voucher clarification which has been there, and this budget proposes to remove the time of supply which was been given. Now the other important amendment which has been given, where I feel this is something which the government could have handled it better. They should have tested it prospectively instead of retrospectively to give the confidence to the taxpayer, but somehow they have restored to do a retrospective amendment. So the question which was there was that I do a construction of an immovable property and I'm incurring GST on my various expenditure. After this immovable property has come into place, I am renting this to various people. So I am collecting GST from my tenant. The question was that can I offset this GST with my GST paid to various vendor on my construction service? Can I do an input tax credit adjustment against this output tax of rental? The plain reading of 17.5C and D told that you will not be able to do. There was a Odisha High Court decision which told that you will be eligible to take the input tax credit, which was challenged before the Supreme Court, and the Supreme Court came with a verdict saying that, please see, there are two clauses of restriction. One is 17.5C, another is 17.5D. 17.5C makes a reference of plant and machinery, which is specifically defined, which restrict you to take the credit of the civil structure other than that being a platform for a machinery. But when you come to 17.5D, there is no definition, there is no reference for plant and machinery. The reference is for plant or machinery. So you should not read the definition of plant and machinery for the purpose of D. So any goods and services other than the works contract which you are taking, you have to look at plant or machinery in its common parlance, and subject to functionality test, if it is undergoes, you will be eligible to take input tax credit. And they told against the renting, all the goods and services you have procured, you are eligible to take input tax credit, is the decision of the Supreme Court came. Now, considering the definition of the Supreme Court decision in case of supervisory trade, what department has told is that no, for 17.5D also, I am replacing the word plant or machinery with plant and machinery. That means to say, whether it is a works contract or an indigenous goods or services, it will qualify to get input tax credit if it is in a civil structure only when it is a platform for holding the machinery. In all other cases, it is not eligible for input tax credit. So the original question, whether I can offset it against my rental, the answer for that would be no, with a retrospective effect from 1st of July 2017. So this is what has been happening proposed now, and more or less this we have been historically seeing finance bill will convert into finance act. There will be no much changes which is going to be there. I am not looking at any changes coming here also. So now what is going to happen here is that if you have already taken some credit and pending for this particular decision, you had kept it pending, reverse it because you have not utilized, no interest or no penalty. If you have already utilized, you have to reverse it, and there will be a possibility of they asking you the interest, because penalty will not come if you have voluntarily done. But interest also, there is a decision of Star Paper Mill Supreme Court where they told interest cannot be levied in case of a retrospective amendment which has happened. So that is something which has to be tested in those cases where you have already utilized. So this is something which could have done in a prospective manner. At least the whole dispute could have been settled. But unfortunately, they have done it on a regular basis. Now there is also a provision of credit note. So most of you would be aware that there is a provision, section 34, which talks about issuing of a credit note in case of rate difference or in case of a discount or for any reason the valuation is lesser than what which was actually valued. You can give a credit note and reduce the output tax to the extent of the credit note which has been given. Remember, credit note, debit note always will be given by supplier. So if the supplier is giving a credit note, then there is a reduction in the output tax which has been paid. Now they've introduced a new section, new condition for this. What they say that you can issue the credit note and reduce your output tax liability if your recipient, being a taxable person, has reversed the input tax credit if he has availed the input tax credit. If he has not availed the input tax credit, reversal is not required. If he has availed the input tax credit, you have to ensure that he has reversed the credit. For this, there is a circular 212 which talks about taking a declaration from the recipient if it is less than 5 lakh rupees self-attested, or if it is more than 5 lakhs from their chartered accountant. So based on that, you can take the acceptance declaration from them, and this condition can be fulfilled. So this is a new condition which has been given. Then there was also a reduction of the pre-deposit in the case of second appeal. So whenever you are doing an appeal, you are supposed to pay 10% at the first stage and another 20% at the second stage. In total, you are ended up paying 30%. What they have done now is that they have reduced the pre-deposit uh, to pre-deposit to 10% instead of 20% in case of demand notices. Now, in case of penalty and you are fighting only penalty, there was no pre-deposit. Now they have introduced a 10% of pre-deposit. And penalty under 129, that is that check post or whatever the e-way bill related detention of vehicles or movement of goods which has happened, there you are supposed to pay 25% of the penalty. Now that has been reduced to 20% only of the penalty, because 129 imposes 200% penalty of the tax which has been evaded or proposed to have been evaded. So on that 200% of demand, you have supposed to pay 10% only now. That is 20% you will end up paying. Instead of earlier it was 25%. So that is you would have paid 50% earlier. Now it has come to 20% only. Now there is also a tracking mechanism which they have introduced or proposed to be introduced only for those specific goods, and this will be applicable to the person who is dealing with that specific goods. These people have to affix a unique identification mark and electronically store certain data which has been required. Certain records has to be maintained and it has to be furnished within the particular period, like the installed capacity, duration of operation, etc., etc. So these are all those sensitive places where the tax evasion is more. To arrest the tax evasion, they are looking at this particular provision, which is going to be notified only for a specific person. So other amendment which has been there is the SEZ and FTWZ. So most of you would be aware that when the goods has been received in an SEZ, when the goods has been custom, it is supposed to be there in the bonded warehouse. And when the goods has been sold from one particular SEZ to another particular SEZ, that is been treated as a transaction happened outside India and no tax should be levied. So considering this, Schedule 3 have amended and they are telling that any goods before clearance from SEZ, the sale happens between an SEZ or to an SEZ or a free trade zone to free trade zone. Those sales from SEZ to SEZ would not be considered neither supply of goods nor supply of service. And the meaning as specified under the Special Economic Zone Act for this purpose will be there. Earlier, if you already paid tax, you will not be eligible for the refund. So these are the amendments which has been proposed in terms of customs, central excise service tax and GST. These are the provisions, these are the proposals which is there as far as the budget is concerned. I will try and answer the questions which is there in the chat box. Meanwhile, after Mr. Butchibabu, any specific questions is there, I am available to clarify your doubts. I sincerely thank IACC and all the organizing member for giving me an opportunity to be here and share my thoughts. Thank you all.
Thank you, sir. Thank you so much for such a detailed presentation and so much information about the budget announcement related to indirect taxes. Now, I request Mr. Butchibabu Gorantla, sir, to kindly address the members regarding the direct taxes portion of budget. Thank you.
Thank you, Sika. Thank you, IACC. Thanks for this opportunity. I would like to start with, anyway, thank you, Sudhir. It's an excellent presentation. I would like to start with the just showing the thrust on where this budget has keep its more importance, which is primarily this agriculture, MSME, investments, and promotion of exports. So mainly the budget has focused towards this is their prime agenda. And I would like to give a very basic input about how India is managing its funds, which is how our rupee is coming and how rupee is going to. As of today, this Indian state of economy is primarily driven towards the collection of taxes and this putting into the efficient use of the those funds. In India, right now, personal income tax is 22% of the whole of the collections and 17% of our revenue comes from this corporate tax. Earlier, 5 years back, this was not the case. Actually, corporate taxes were much higher than the personal income tax. However, in the last 4 or 5 years, this personal income tax has exceeded the corporate tax collections. Right now, 22% of our income tax is accounting for the personal and 17% of corporate tax is towards these direct taxes. Overall, our under 17% is towards the GST, and as of now, 66% of the total of our inflow is coming from the direct and indirect taxes. And still, we are living at the 24% of the budget is moving on the borrowings. So we are heavily loan-driven economy, and out of our outflows, at least 20% is going towards the interest payments of our on the borrowings. Excuse me. So in this context, the tax collection has become robust, and also the responsibility on the governments to make sure that there is no escapement of the taxes. So for the last 10 years, the people are burdened with the lot of income tax with no respite from the government, even though inflation has been is rampant. Still, the government didn't give the much of relief for this middle class and this other segment people. This budget has given a very decent attempt to reduce the income tax burden on the middle class people, or the up to 12 lakh, 15 lakh, whatever. I'm going to come into the next slides. However, I'd like to give a very brief introduction about the MSME changes happened in the budget. In the media, you might have seen this. Many people are covering about the income tax and this related changes, 12 lakhs, etc., etc. So I feel that it's a very appropriate moment because most of the members of IACC are the MSME segment. So the budget has given a decent effort to revise the MSME definition. Basically, MSMEs have been segregated into three categories. One is micro, small, and medium. And they are categorized into based upon the investments and the turnover criteria.
Sir,
In the-
sorry to interrupt. Can you make full screen, sir, please?
Yeah.
Yeah, this is fine, sir. Thank you.
Okay. So MSME segment, micro, small, and medium. The plant and machinery is up to 11050 and the revised limits are 2.5, 25, and 125. So exactly, investment criteria is for the plant and machinery. So if our plant and machinery in a company is less than 1 crore, it is micro, it is less than 10, then small, then less than 50 is medium. Which was the earlier criteria. Now, if you see the limits, which has been drastically increased, almost 2.5 times, and the same way the turnover also. If the current turnover is 550, 250, the same has been doubled. That is 5 to 10, 50 to 100, and 250 to 500. So if a company has plant and machinery investments less than 50 crores, or if their turnover is less than 500 crores, still they are treated as a medium enterprises. So all the state governments has a different policy for the small and medium scale segment, that is MSME we call in a short form. So MSMEs can get a benefit due to this change in the definition of the MSME. So the first benefit that might accrue to the MSME units is in the form of the, there is a scheme in the banks, that is credit guarantee CGTMSE scheme. For that, there is no collateral is required to get those loans. So right now, the MSME revised definition is going to help the people to get those loans under that category, which is under priority sector lending, and the interest concessions are there and no collateral is required. So the MSME units can make an advantage of this. Apart from this, the government has also made a decent attempt to revise the credit guarantee scheme related amounts also. Right now, MSMEs are entitled for 5 crores. Now that amount is increased to 10 crores. So to take an example, if a small enterprise having a less than 100 crores turnover, they're a small enterprise and they can have a credit guarantee scheme without collateral, the bank loan up to 10 crores. That is a very good moment to encourage the business segment. And in the case of startups, it is increased from 10 crores to 20 crores. Apart from this, if the MSMEs are into exports, they can get term loan up to 20 crores under credit guarantee scheme. This scheme is without collateral. Probably the change in the investment and the turnover definition to classify the MSME and the change in the CGTMSE scheme to the small scale segment people is a welcome phenomena. And apart from this, budget has given an attempt to create employment and export opportunities for this toys, footwear, food processing, and leather. And some of the food processing parks have been announced for Bihar. And likewise, the government is going to come up with a different scheme for the toys manufacturing, because the government would like to do toys as the global manufacturing hub for the toys right now, which is we are predominantly dominated through China imports. And business point wise, the new income tax is going to come, which is this week they are going to announce, and probably we will have one more session once this has been announced, and they are going to make exactly half the present size of the income tax. So they wanted to simplify the understanding, they wanted to simplify the laws. However, we are yet to see how that is going to make an impact for the ease of doing business and reducing the compliance costs on the companies. Also proposed to decriminalize 100 acts. So it's a welcome move, because right now a lot of compliance costs are high and a lot of interest and penalties are mandatorily being levied from various aspects for small lapses also. So the decriminalization is going to help. And the company law related fast mergers and acquisitions are going to come. They wanted to give a special scheme for this MSME segment where mergers and acquisitions are under pipeline. They wanted to reduce the timeline and the compliance burden on the companies. Right now, mergers and acquisitions, that is going to take at least 9 months to 12 months. So they wanted to work on both the angles of reducing the same. Then this Atal Tinkering centers are going to come to encourage the startup ecosystem. And another important change is India Post is going to be termed as a logistics hub. So that will help the SMEs to plan their logistics, because India Post has a lot of vast network, which is no less than to the big guys. And expansion of IITs and power reforms, small nuclear reactors for power generation, and there is a Urban Challenge Fund with 10,000 crores, and the Udan scheme is going to be increased to another 120 cities, and a Maritime Development Fund of with 25,000 crores is going to be established. National Jal Jeevan Mission, and states are going to get special support for infra development. From the financial reforms wise, the companies are going to get central KYC. So henceforth, the KYC mechanism is going to be very easy for the financial sector startups. And the good change is to 100% FDI is allowed in the insurance sector. So for the companies who are making all investments, premium investment in India, they are entitled for 100% FDI for insurance sector, which is much needed change. The industry was voting for it for quite a long time. Now that has come into reality. So these changes are morely towards this business and how this operations operates and all these things. Now I'm going into the key aspect of my presentation, which is the direct access changes. So for the last 4 or 5 years, the government is pushing the people to go into new regime, which is the taxation. Suppose if we have some income, and earlier we used to have a lot of exemptions. One is for HRA and medical, relevant changes of the relevant allowances we do get from the various employees, and also for investing in insurance and home loan, medical insurance, etc. However, the government is pushing the people to go for not to claim any sort of exemptions, to make it much more simpler, very easy. And in that line, last 3-4 years, they made a very decent attempt, and they rationalize the rates. So for the old scheme part, I'm not going to discuss here, because the new regime is the thing now. Right now, for earlier years, on the right hand side, I kept this what is the earlier taxes, and on the bottom I gave on the left hand side I gave what is the new rates proposed by the income tax in this budget. So right now the new rates are up to 4 lakhs nil, 4 to 8 lakhs 5%, 8 to 12 lakhs 10%, 12 to 16 15, 16 to 20 20%, and 20 to 24 25%, and above 24 lakhs it is 30%. Whereas earlier it is 5, 10, 15, 20, 30. However, the slabs are different. Now the good thing is it is easy to remember, because it's all about multiplications of 4, and right side it is the multiplication of 5. So this change has much awaited and long been planning. With a rider this, the budget also proposed that up to 12 lakhs, there is a rebate, special rebate is going to come, to be given to the people. So if you have an income up to 12 lakhs, there is no need of paying any taxes with certain riders. So these last 2 to 3 days, we are seeing across the media and various channels, various social media front, lot of doubts being arise, like, what is this 12 lakhs thing? So I just would like to make an attempt to expand a little further. So the budget has given the slabs 0 to 4, that is nil, then 4 to 8, 5, like this. So this amount will be computed first, and up to 12 lakhs, 60,000 will be the tax will come. So that 60,000 will be given as a rebate. It means if at all we have an income more than 4 lakhs, we have to file an income tax return. However, if our income tax is less than, our total taxable income is less than 12 lakhs, then we have to claim that as a rebate. So people thinking that up to 12 lakhs, okay, I don't need to file a return. No, that is incorrect. So up to 12 lakhs also, if you have more than 4 lakhs, you have to file an IT return, but claim that whatever the tax exemption that is up to 12 lakhs, the rebate amount that you can claim. Further, right now there is a 70% of the total population already moved into the new regime. Probably with this change, up to 100% also will go into new regime. So there is now henceforth no one need to plan their taxes and save the. Of course, we don't say that not to save in those instruments. However, don't plan your taxes for the sake of tax savings, because in a permutations and combinations method, we have drawn around some 2 to 3 tabulations. And also I have gone into this earlier statistics of the income tax. Up to there are last year, that is, I mean to say 20 to 23, almost 8 crore income tax returns have been filed. Out of which at least 7 crores returns are having less than 12 lakhs income. It means out of 8 crore return being filed from the personal income tax category, which is including the corporates, almost all the individuals 7 crore returns being filed with less than 12 lakhs. It means the complaints will be there. However, all those people don't need to pay any income tax subject to certain riders. So plan that will, number one, that will ease the complaints burden on the companies in terms of TDS. So people having a say payroll of around 12 lakh 75,000 payroll cost, that is the gross salary on an annual basis, excluding their leave encashment. Then all those people related tax computation don't need to happen. They just need to make only PF and ESI related complaints, if any. And this is a very good change from the business perspective. And from the middle class perspective, this is a very big change, and almost is going to save a lot of amount of income tax. However, from compliance perspective, the people have to file their IT return and show the exemption amount. So on comparison, I try to make what is the benefit to the people. So up to 12 lakhs, the benefit is around 60,000, and up to 18 lakhs, 90,000. The maximum benefit anyone can get above 24 lakhs is around 1 lakh 10,000. So almost people who are all having a taxable income of above 24 lakhs, they have a savings of 1 lakh 10,000. That is a good saving considering the last 6-7 years inflation taking into consideration. The government has made announced that they are going to forego 1 lakh crores out of this. However, the actual computations will take a time to assess it. However, for this, there are riders. Say the question I got from some of the people is whether 12 lakhs is a blanket exemption for everything. No, it is not a blanket exemption. Basically, the cases where there are special rates are there. Say for long-term capital gains tax of 12.5% and short-term capital gains tax of 15%, or any crypto earnings of 30%, and these winnings and speculative incomes, etc. So they are all continue to stay. So to take an example, if a person is having a long-term capital gains tax, then they have to pay 12.5% tax without looking at these regular rates, which is 5%, 10%, 15%, etc. So they have to pay the tax on the specific income. However, they can claim the basic exemption of 4 lakhs related on this. So this is the major change that we need to observe, because the volume of the returns that are going to be having this kind of a benefit, that is rebate benefit, is very high. So people must be watchful about whether there is a short-term capital gain, long-term capital gain, crypto earnings, etc. So those people should not think that 12 lakhs exemption is for them also. That 12 lakhs income exemption is primarily for the sources of salary income and rental income and business or profession. So that is regular business heads we call. So special rates are exempted out of this. And there is also another concept called marginal relief. So suppose if you have an income more than 12 lakhs, say even 1 rupee, or say 12 lakh 50,000 rupees, just for the sake of having 50,000 extra than 12 lakhs, they have to pay a tax of around another 65,000 or so. Then in that scenario, the maximum tax payable is only 50,000 because there is a concept of marginal relief. However, that concept was there for a while also. And apart from this, the other important point to note is HUFs are not eligible for this taxation rebate. That was there from day one. So some people inquired with me yesterday that whether HUF also having the same benefit. No, HUFs are treated with they are not eligible for rebates. So HUF income is exempted only until 4 lakhs. And then again, they have to go file the regular taxes. That is same 5, 10, 15, 20, etc. So this is the major change. And from the direct point of view, other than this, now there is certain TDS rationalization, etc. that I'm going to come. Before that, I would like to just demonstrate how we are paying our taxes. Just I did a basic computation and just put the average rate of tax that you are paying in India right now. I'm assuming up to 12 lakhs with the regular incomes. So up to 12 lakhs, zero tax. 16 lakhs, they are paying an average of 7.8%. I'm totaling like, total tax by the total income. So the tax table is given, and also on top of it, we have to pay cess and also surcharge. That surcharge is applicable only from 50 lakhs to 1 crore, 10%, and 1 crore to 2 crore, 15%, and 2 crores and above is 25%. It is same. However, this only in the new regime, because this old regime is not going to be beneficial. Probably at least 95 to 96% of the cases now will move to the new regime. And the average rate of taxes for 5 crore people is 37.91, for 2 crores, up to 2 crores, 33.37, up to 1 crore, 29.52, which is including the surcharge and cess that I'm talking about. Up to 50 lakhs, no surcharge. However, there is a 4% education cess is there from 4 lakhs onwards. So I gave this is how we are getting income tax. So up to 24 lakhs, 13%, that looks to be, suppose if you take other countries into consideration, that is on very lower side. So still India has a very lower amount of income taxes, even after considering the purchase power parity with the West. And from 50 lakhs onwards, the tax rates are higher in India when compared to the global incomes, that is developed countries. So there is a still long way to go. However, the relaxation given in this budget is a very welcome move that will help the country to increase the consumption. Right now, the economy is getting slowed and consumption is getting contracted. So the government has think that, okay, instead of collecting this way, let us encourage the consumption in the economy that will increase the taxes. And that is GST collections, and that will also create the employment and the growth. So this is about the major change about the income tax for the personal level. And for the corporates, there are no changes. Nothing has been mentioned. I think for the corporates, rates wise, there are no changes will be announced in the income tax bill also. That is, the new bill is going to come in this week before the parliament. However, they have done this TDS rates have been rationalized. There is a lot, and also the slab limits have been increased. So to quote something, interest on securities, earlier proposed threshold is 10,000. Earlier we need to pay TDS from 1 rupee also. Interest on securities, it is 10,000, and dividends for individuals from 5,000 to 10,000. And interest on securities for this senior citizen, other than securities, is for the say bank deposits and all that. 50,000 was earlier TDS limit. Now up to 1 lakh, there is no TDS. The same way it is given 40,000 to 50,000 in other case, 5,000 to 10,000. So the basic attempt is made to reduce the compliance cost for these small cases, because many of the people are getting tax deducted, but their incomes levels or their ability to file an income tax return is very low. Mainly this has happened in this tier 2 and tier 3 cities or towns. So the rationalization has been happened. Also, the income tax department budget has put an effort to raise certain slabs also. For example, insurance commission rates have been reduced to 2% from 5%, because those commission people are taking this high amount of refund cases are increasing. So the government wanted to just collect whatever is the tax due. The same way, lotteries and winnings, earlier 10,000, now also it is 10,000. Now Now winning from race horses, etc. Of course, that is the least applicable item for this audience. The same way, the limits have been raised for lottery tickets 15,000 to 20,000, and commissioner brokerage earlier it was 5%. Now it is increased to reduce it to 2%. Also, the amount has been raised to 20,000. However, this I personally feel that not much of a changes in terms of the TDS things are concerned. It is just like 10,000 made to 20,000 or 50,000 is made to 1 lakh, etc. The biggest change is good change is the rental related TDS. Suppose if any individual is getting an income rent from anyone, any business concern, right now monthly 20,000 rent also TDS is applicable, that is at 10%. And at the end of the year, they are going for full refund. So it is going to have burdensome for the people who are filing. They have to file an IT return just unnecessarily, where their income is zero. Still there is a TDS, so they have to claim full refund. So it is a burdensome for the people to file a return, and also it is complaints cost on the government to process the IT return and again claim push the refund to the party. So to curb, like at least to cut short the complaints burden, at least on some people, the TDS amount on the rent is 50,000 now. So per annum 6 lakhs. So if any person is paying 50,000 or more, they have to deduct TDS at the rate of 10%. So this 50,000 per month basis we have to look at, not like a 6 lakhs per annum. So if our rent is 50,001 rupees, we have to pay TDS at the rate of 10%. Earlier it is like a 2,40,000. Just we can take on like 1 year basis. So the small change, yes, 6 lakhs, but it is subjected to 50,000 per month. So TDS provision, because in SME segment, rental TDS is one kind of a headache where people don't want to have TDS, but this is like a mandatory phenomenon. And in respect of certain mutual fund units, again, the TDS rates are rationalized, and TDS rates rationalized for professional services also. Earlier up to 30,000, now the small increase is up to 50,000. So these are the TDS rates rationalization, and the important thing is trust related earlier 25% and 30%, but that has been reduced to 10%. That is a very, very welcome and great one, because it's working in terms of the people who are having investments with AFs, that is alternate investments, fund investments. The TDS has come down drastically, and very good thing that, because at the end of the day, the tax will not be that much. It's not 25% or 30%. So TDS is 10%. Even if an average of tax rate is 20% also, they used to get a refund of 5% or 10%. Now that has been streamlined and rationalized. And for the last 4 years, the people are burdened with these TCS rates for the LRS remittances, because the kids' education and the foreign trips, travel, medical, etc. So about 7 lakhs foreign remittance, the TCS used to be there. However, the TCS is always entitled to claim as a credit, so that we used to reduce our advance tax burden. However, to give a breather to the middle class people, the TCS rules have been rationalized. So earlier 7 lakhs was the limit. Now that has been moved to 10 lakhs. So it is a good move. And if any person is doing LRS by taking an educational loan, earlier 0.5% was there. Now that has been made to nil. It is simply to reduce the compliance mechanism, both from the bank's perspective, financial institutions, and the forex remitters. At the same time, it also is the burden on the parents of the students who are sending funds for their kids' education, and they are not aware of TCS, and they don't have generally a tax payable income. So it is primarily aiming towards the reduction in the compliance, both in the nature of volume and the cost. This is a very good move from the TCS rationalization point of view. And for the business houses of forest produce, that has been reduced from 2.5% to 2%. And the other direct tax proposals are for the individuals, basically again, we already mentioned that up to 12.7 lakhs salary, there is no tax. Or more, up to 18 lakhs, 90,000 will be the benefit, and up to 24 lakhs, 1,10,000 will be the benefit. So some certain other changes are there, but they are not very important from the new regime tax perspective. However, I'd like to mention here. One good thing is, and one major change is, suppose if any employer happen to incur some medical expenditure, suppose on any of their employees, and if their medical expenditure happens abroad, then that amount is used to be as a perquisite. So for the employee welfare and the safety and health concerns, if an employer pays some amount towards the abroad medical treatment, that paying tax on this is not a very welcome, or like it's not a warranted thing. So the department has corrected this change by making, if any employer provides a medical health benefit for incurring expenditure towards abroad also, no need to pay any income tax in the form of perquisite tax. Earlier, domestic was already tax-free, but it is on like the company has to pay the incur the health cost, that is medical expenditure, not for anything else. So this is a good move. And there is something introduced last year, that is maybe this year only, 24-25, in the somewhere in August, September. NPS Vatsalya. NPS is what we call is a national pension scheme. National pension scheme contributions are tax-free up to 50,000 under old regime. Now NPS Vatsalya also has been added to it. What NPS Vatsalya is, now even you can open an NPS account for the kids also. So kids can take that amount when they at the time of their retirement. So this is to induce saving system into the economy, and also to make the kids to be aware of their retirement needs. So NPS Vatsalya came up, and the minimum deposit is only 500 rupees per annum, and there is no maximum limit. However, up to 10% of our salary also can be contributed to NPS Vatsalya. At the same time, up to 50,000 they given as the exemption amount, but this is applicable only in the old regime. For the not under the new regime, it has no relevance. So old regime people can claim that NPS instead of in their name, they can also have NPS in their kids' name. So NPS Vatsalya is the one such benefit. And another important change for the middle class people considering is under income from house property, you are entitled only for one house as the self-occupied property. And the second house, suppose if you have 3 houses, one house you have to show as self-occupied, and the second house you need to show some rental income and pay income tax by showing that as income from house property. So now the department has given increase the exemption to one more house, considering the people are highly mobile and going to the other cities for their settlement. Still they have one more house at their native places. So they gave this benefit. So up to 2 houses, self-occupied property, there is no deemed rent. There is no need to show as deemed rent. This is a very small change. However, this will again reduce the compliance burden and the related things. Now coming to the business perspective, from the this is applicable only for the people who are going to have the transfer pricing regulation. So primarily and IT and pharma and other who are into exports, who are having this sister concern abroad or their wholly owned subsidiaries abroad. Right now the transfer pricing mechanism is there, and the transfer pricing has to be computed on 5 models. However, it is like cost plus profit or certain profit margin to be attributed to the Indian entity, even though they are support centers or service centers. Generally, companies tend to get that is into a cost centers. So they used to reimbursement only the cost. But now transfer pricing, which is almost 15 plus years now. So the TP is a mandatory, and the TP assessments have become very headache for the industry. So in that scenario, TP pricing has to be done on an annual basis. So the assessment has to will go on annual basis. Now a relaxation has been given by this budget. What they said is that, okay, transfer pricing regulation, if you are doing an assessment for 1 year, if you don't have any objection, we will apply the same thing for the another 2 years also. So it's a kind of a block assessment. So for 3 years, the same rate we can apply based upon the earlier assessment. So for that we have to opt for that scheme. So if one assessment, if they assess that, say 12% is your markup, then if I'm agreeing to that, so we will get an option to include this, apply the same option, that is same 12% for the next couple of years also. So 3 years at a time we can handle. So this will reduce this paperwork a lot. Otherwise, earlier, every year is a new system and every year is a new computation. So once the officer changes, their perceptions and interpretations changes. So accordingly, we will be getting rid of the compliance burden and also this interpretation related issues. So once before the amendment, we have to provide the same arm's length pricing model. Once an analysis is conducted and the transaction is accepted, then we can apply the same thing for the next 2 years also. So 3 years we can do it. That will definitely help the companies to reduce the litigation and concentrate much more on the business effort. And the another thing is safe harbor rules thing. The Prime Minister, Finance Minister already mentioned in the budget speech that safe harbor rules scope and other things will be expanded. However, there is no such specific mentioning about the same thing in the any document of the budget. So what we are expecting is this safe harbor rules will be much more simplified and much more comfort and easiness to companies would be given in the upcoming IT bill. We are hearing that a lot of emphasis will be given for much more clarity on this various litigation, wherever these litigation chances are there, they wanted to reduce. So definitely safe harbor rules will be addressed. And for now, the proposal is regarding to transfer pricing 3 years in one time. And the other changes that have been come to is if any electronic manufacturing companies, designing companies are taking services from non-residents, so to reduce the burden on the non-residents taxation, there is a new section has been introduced, that is 44 BBD. There is a presumptive taxation. There is one concept is there under 44 AD. So there where we don't need to maintain any books of accounts, we just need to book our turnover, and based on that and turnover, that profit margin we have to pay. So right now we have the presumptive taxation schemes are there for up to below 2 crore, up to 6% for full check and up to 8% for cash and check mechanism. That was the presumptive tax rates. So where we don't need to maintain any books of accounts on our payments, we don't need to do any tax TDS collection, or we don't need to do any TCS application, etc. It is to just to give a peace of mind and for the easy computation. So this presumptive taxation for non-resident providers, it has been allowed only for the electronic manufacturing services companies, but there should be an NRI. So their 25% of our total income is treated as the profit. On that, they have to pay the tax. So this is useful for the non-resident people who are coming to India to service to the concerns on a temporary basis. And another thing has been given at present, tonnage tax is there. Suppose if any non-resident is there and if it is a shipping company, that shipping company has to pay income tax on their shipments based upon the tonnage. So whatever is the tonnage they are operating, and per ton they can compute certain amount, that is the department has given a number. So on that tonnage is treated as an income, and on that they have to pay the income tax. This is also to reduce the paperwork and hassle-free assessment and all that stuff. So same tonnage tax has now been extended to the inland water vessels also. Right now, this benefit is available only for non-residents. So now this budget has introduced this benefit even for the inland vessels also. It is for to encourage the inland water transport, inland transport they wanted to increase. For last 3 years, Government of India is trying to come up with water transportation facilities. They wanted to encourage for the ships and boats to handle the most of the logistics in the inland also. So to encourage and to line with their estimations and expectations, they keep this tonnage tax even for the inland vessels. And other two important aspects, one is like, it works in a negative way. In case of mergers and acquisitions, if any losses are there for the previous company, then in the present situation, under Income Tax Act, losses can be carried forward for 8 years. So up to 8 years, we can carry forward the losses. However, in the case of mergers and acquisitions, our years start with number 1, that is after the post reorganization, that is post merger onwards, again 1 to 8 will be given. So now the department says that no, it is only 8 years from earlier company, that is predecessor entity. Whoever is the predecessor entity that started incurring losses, from that year onwards to 8 years, not start from first year of the merger. So this is to discourage the people who wants to go for mergers and acquisitions for income tax benefits just with an intent to carry forward their losses. And another important change is there is before last year, they have introduced an updated return. Updated return is for the people who have filed a return. So if they find some mistakes, some lapses, some errors have been happened, then they can file file an updated return, but they have to pay 25% excess tax instead of the interest and penalty. So earlier up to 12 months, 25% excess tax to be paid, and for up to 24 months, 50% excess tax to be paid. Now they extended the same thing for 4 years. So if you think that 3 years back you had done a mistake, then you can update the return by paying 60% additional tax. So earlier it is tax plus interest plus penalty. Now the tax plus additional 60% tax is going to take care of the amount towards the interest and penalty. So it is primarily to weed out the mistakes, voluntary mistakes, or like the suppression related issues. They wanted to discourage the thing. To quote an example here, 1 month back or like 10 days back, we got a media this thing that at least 90,000 plus notices have been sent to various employees for claiming false allowances. So they are giving wrong declaration to the employers without having one such example is they are showing certain amount towards the trust, which is not a genuine donation, and they are not doing, they don't have a handicap dependent, still they are claiming an exemption, or they are showing a donation to a political party, but actually there is no donation. So in those cases, at least the 1,000 crore tax has been escaped. For those people, those employees, the income tax department has already issued the notices. So now if they go for assessment, the tax will be, there will be tax, and then there is an interest, then there is a penalty. Now to reduce that kind of a process, and it's a kind of giving immunity from prosecution and immunity from penalties and immunity from hassle, this thing, the department updated return concept is helping a lot. To go by statistics, as of today, updated returns has given an income of 9,000 crores to the exchequer. So for the small people, that is around, I can say below 20 lakhs people, if there are any income tax errors in terms of computation or false calculation or false claiming of exemptions, their opportunity is up to 4 years now. So first year 25, second year 50, and third year 60%, and fourth year 70%. So this is tax plus 70% of the tax up to 4 years, like that we have to compute. And this will help the companies and also not the companies, for the individuals and other people to be coming to 100% compliance by rectifying their mistakes. However, I personally feel that the tax rates given are very high, but the department has proposed for such a thing. So probably an amendment might be taken up in the session. Then there are minor changes with respect to the definition of a capital asset and what is a capital gains for this. So any security held by the investment fund would be treated as a capital asset for years starting from this year. The same are to be taxed as a capital gains and not as income from business or profession. This change is basically to help the category 1 and category 2 alternate investment funds, where there is an ambiguity with respect to their tax on the sale of securities. So they have changed the definition so that their taxation will be streamlined and rationalized on par with the rest of the things, and also to clarify the present tax mechanism. And another important thing is startups. Startups income tax exemptions are going to be extended until 1/4/2030. Basically, earlier the company to be incorporated within 3 years. Then that is once the maximum 3 years, within 3 years they have to go for registration. Now the same thing has been extended up to 5 years. So if a company is incorporated and get a registration as a startup, up to 5 years, that is whatever the startup benefits they are entitled for. Say, for example, if our company is incorporated 1/4/2029, still they are entitled for startup benefits, because even though the present regime says that only 3 years, now it is until 5 years. Then the benefits will continue as usual. 3 years income, no income tax, etc. In a block of 5 years, etc. That will continue. And capital gains for this non-residents, one provision has been corrected. Last year, the capital gains tax rate is 12.5% for the individuals and other. However, the non-residents of certain categories still at 10%. Now that anomaly has been changed to 12.5%. Then in the case of business trust, that is REITs, Real Estate Investment Trust, and Infrastructure Investment Trust, they are going to be taxed at the maximum rate of tax. This is for the trust case, maximum marginal rate is there under section 11A. And this is more of a clarificatory and also a rectification of the intent of the legislation. And there is a concept of significant economic presence. Suppose if any foreign entity is operating in India, and if they are having their by turnover wise, volume wise, there is a certain parameters and classification has been given. Then in the case of significant economic presence, there were cases that the income tax also payable in India. So there was a representation from the foreign companies who are just handling the goods, where they just procure the goods from India and then export to their respective countries. Still, those cases, they are getting a tough thing, because this is becoming as a deterrent to promote exports. So to encourage those units, so the foreign companies who are having a presence in India, just for the sake of purchasing goods and then exporting out of India, so they are out of significant economic presence. So accordingly, their transfer pricing compliances will come down, and their tax rates will also come down. And henceforth, this alternate investment funds, category 1 and 2, their sale of securities will be taxed at normal rate at 12.5%. Earlier, the anomaly and also certain things that the AAF 1 and 2 category incomes were treated as a business incomes. Hence, their tax was up to 30% for resident and 39% for non-residents. So the category 1, 2, basically the difference is 1, 2, 3 categories are there. For income tax wise, 1 and 2 will operate on a different platform, and category 3 will operate on a different platform. In the case of category 3, the trust will pay the tax, and the beneficiary, that is the unit holder, don't need to pay any taxes. It is his exempted income, but the trust always used to pay at the higher rate of income. Now, in the case of category 1 and 2, basically these are pass-through entities. In those cases, they just gave us a certificate and showing what is the dividend income, what is the capital gains income, and what is the business income, etc. And that amount we have to show in our returns and pay the applicable taxes. So there was a conflict whether sale of securities of those AIF 1 and 2 are the business income or the capital gains income. Now the government has changed the definition. In the earlier slide, I have already showed that definition. And now they made the change to the capital gains at 12.5% and clarified that the sale of securities will fall under capital gains. Even though primarily the objective is to, they are into business also, and still this the activity is investments, hence the tax rate has been normalized to 12.5%. This is a good move. Earlier, I have seen many of my clients has paid tax at the rate of 30% because that certificate used to show as business income instead of the capital gains income. Now with this change, the AIF 1 and 2 sale of securities will be treated with the on par with the capital gains taxation, and for individuals the tax rate is 12.5% for long term. And one important thing, it's going to save the tax for the individuals, which is about the ULIPs. Last 4 or 5 years, the ULIPs about 2.5 lakhs are going to be charged. So the ULIPs are primarily market-driven investments things, unit-linked insurance policies where insurance is also there, and but primarily their investment return is the markets. So people used to save a lot of income tax by investing in ULIPs because ULIPs redemption used to be tax-free. So 2 to 3 years back, they introduced a mechanism. If any ULIP, you are paying a premium of say 3 lakhs, up to 2.5 lakhs is only tax-free, and on the balance 50,000, you need to pay tax. How it works is, say I'm just quoting one example. If your ULIP is say 5 lakhs premium, then say after 10 years, you will be paying say 50 lakhs, out of which 25 lakhs will be anyway free. So the 25 lakhs related gain is also free. And suppose on the balance 25 lakhs, if you are going to get another 10 lakhs, that amount of 10 lakhs is to be treated as the other income. So you have to pay maximum rate of income tax. That is your slab as per 20 or 30 or whatever you are into. So this budget that has corrected it, and because ULIPs are primarily an insurance policy but backed by market related investment, that is the specific segment and the trust or the mutual funds or whatever it is. In that scenario, the present tax rate is 12.5% for an individual for a long-term capital gains. So now ULIPs are also going to have that same tax rate of 12.5%. So they are treated as the capital gains instead of as the other income, which is like an interest on deposit, etc. So definitely this is going to be a positive factor for insurance companies and also for the investors, that is individuals and other people. This is a very good move. Basically, it is like a streamlination or a rationalization of the existing slab. So capital gains to be taxed at 12.5. So ULIPs are also going to be taxed at 12.5% instead of as a other income, which is a good measure, and it will help. Now certain dates have been extended for certain sovereign and wealth funds. There are many countries operating their wealth funds and sovereign funds, also foreign pension funds. So their exemption date has been extended up to 2030. It is just like getting a regular extensions. And category 1, category 2 AIF thing that I have already explained in detail in the above thing. And another change helping for the trust, for the charitable trust and institutions, there are 2 changes happened. Suppose if any trust income is less than 5 crores, total overall contribution is less than 5 crores, then their registration validity is being extended to 10 years. Right now in the present regimen, the trust registration is first 5 years. Then after 5 years, we have to go for renewal. Now what they're doing is up to 5 crores receipts. Now your registration is valid till 10 years. You don't need to go for registration in the 6th year. But the cap is about 5 crores. More than 5 crores, their validity is only 5 years. And under the present trust conditions, there is one concept of investment, specified person. Suppose if any trust is doing some benefit or some comfort, some information or direct or indirect benefit, any monetary or pecuniary benefit is being given to one of their trustee, then the trust is not entitled for the exemptions. So basically also that specified person is treated as the trustees, and also all the people who are doing more than 50,000 rupees contribution, they are also treated as a specified person, and their relatives are also treated as a specified persons. So this is going to become a lot of deterrent for the closely held trust, where the trustees are most of their family members, cousins. So in those cases, if their one of the trustee happen to use one company's car for his that is trust car for their day-to-day duties, in those cases also they are getting their trust exemption being cancelled, or they are being called to the income tax office for the assessment and wanting us to pay the income tax on the trust income, etc. So to give more relaxation, they changed the definition. One is who is the specified person means the person who is giving at least 1 lakh or as a one time in a single year, or at least up to 10 lakhs. Suppose if a person has given 9 lakhs in a period of 4 years, and every year not it is less than 1 lakh rupees, then those people are not treated as a specified person for this purpose. And relatives of those specified persons are no longer treated as a specified person. So if myself and my wife are the trustees, just because I am the contributor of 11 lakhs doesn't mean that my wife is also a specified person. So my wife got any monetary or pecuniary benefit or in kind also should not be treated to claim the exemption, that is, sorry, to cancel the exemption of the trust, or to ask the trust income to be taxed because we are the specified persons. So this is a much long awaited change. However, now the budget has given this leverage, and this is for the charitable trust. And apart from that, this lot of relaxations have been given for international financial centers. So right now, that is in par with this West and the Middle East in Dubai International Financial Center and Singapore Financial Center, etc. Right now, we have one thing called Gift City in Gujarat, that is under IFSC, and those were encouraged to go to Gift City in Ahmedabad and promoting this international financial center. So they are they should be treated as the foreign territories, even though they are operating on the law of on the territory of India. For all regulatory and legal purposes and tax purposes, they are the foreign territories in terms of the financial centers. So they have given first international IFSC has got a certain tax incentives until 2030. Earlier it was until 2028. Now they extended to 2030. And there are tax stops has been given for the insurance companies. If any insurance policy is issued by IFSC company to any person, then the tax that is it should be non-resident. In this case, IFSC have a no need to pay any income tax because their income source is a non-resident, not an Indian source. Similarly, shipping companies getting this shipping leasing got exemption, and this aircraft companies got exemption. And in case of dividends of the aircraft and this shipping is exempted. And also if any loan has been given from their parent abroad company to a group subsidiary or vice versa. Suppose if an Indian gift seat IFSC registered company has given a loan to a another company, even on the regular terms, here we have certain concept called deemed dividend under section 222E. So deemed dividend has been waived off for the IFSC companies. So this slide is predominantly for the IFSC companies and how their tax stops have been announced, both one for the shipping and aircrafts, insurance companies, and this commencement date and the dividends and the deemed dividends. Then also forward contracts, transferred derivatives, these are all financial instruments. Non-deliverable forward contracts, offshore derivative instruments, and over-the-counter derivatives, and the income related to the FPI, that is foreign promotion investors, and the IFSC unit will not be included in their incomes. So this is a one more tax cost. It is basically to give an objective that if any IFSC unit is there, almost all the business operations are tax-free as per the India. So this is about the taxes, and I could take the questions.
Yeah, thank you, sir. Thank you so much for a very comprehensive presentation with so much on information on all the points, business announcements related to indirect taxes, with so much minute details for all our members. So we are really grateful to you. I'll just take quickly the questions, although the time is this thing. We have one question from Mr. Prakash. Will interest paid by kids' education abroad be a deductible in new regime?
No, no such amendment.
Okay. And there's one more question. Are there any financial incentives or grants for business engaged in developing deep tech, AI, biotech, or other IP heavy sectors?
Right now, IP-based only AI tech fund, and to promote the AI's 500 crores grant is being given, and the Atal Tinkering Centers are going to come to boost the tech startups. Per se, there is no specific incentive, or per se, there is no monetary benefit has been announced, or even there are no subsidies or incentives. Both from investment point of view, no incentives, and tax rate point of view, no incentives. It is only to develop more ecosystem by promoting the centers. In the AI and biotech, I didn't see anything specifically. IP and AI and technology is primarily two things. One is a startup. There is an announcement for 10,000 crores contribution by the government to create a fund of funds. So this fund of funds, what they do, they have an arrangement with the SIDBI. So certain AIFs, that is alternative investment funds, have already given their consent to SIDBI, and the government is going to come up with 10,000 crores fund. So those 10,000 crores will be invested in various alternate investment funds, which are duly recognized by SEBI, and those funds will be investing again into the startups.
Okay.
So 10,000 crores has been earmarked, and the guidelines will be coming after the budget has been passed. And SIDBI is the nodal agency. That is, they don't come directly, but they come through a fund.
Right. Thank you. So next is at the outset excellent session wherein budget 2025 has been comprehensively and lucidly summarized. Thanks to IACC and the eminent speakers. Can we request for a copy of presentation? Yeah, sure. I will be sharing the copy of the presentations and the recording of the session also, and also the detail of our eminent speakers with their email IDs. If I'll take their permission, and then otherwise you can write to me and we can forward your queries to both our esteemed speakers. And if you like to take any professional help, you can directly write to them, or you can write to me and we can connect you. So I think we don't have any further questions in this, and members will be absorbing all the information that we got from both our speakers. So just a few lines. I, on behalf of Indo-American Chamber of Commerce, convey special thanks and immense appreciation to Mr. V.S. Sudhir, partner HNA and Company LLP, and to